So I found this article on 5 undervalued blue chip stocks hedge funds are piling into. Now, I don't care about hedge funds, but I do care about 5 undervalued blue chip stocks. So this is the plan for the video. I'm going to go through this article, look at the 5 holdings, read a little bit of what they had to say about it, and then we're going to take a look at the financial information of the company to see if it is a solid buy right now. And then we're going to come over to an independent rating website to see what the general tone of the company is. So sit back, relax, and if you guys enjoy the video, give it a like because it does help out the channel. So number 5 is Goldman Sachs, ticker GS. Goldman Sachs Group is a New York-based financial service company founded in 1869. The stock has returned 42% to investors in the past year. The bank offers various wealth management services and is often a prime broker in mergers and acquisitions. It also offers banking services and market research. The firm markets financial planning, investment management, and a range of other services. All right, so now let's take a look into the hard numbers of the company to see how it is. And there's a few things that I want to focus on. The first one is the forward PE ratio, and we can see Goldman Sachs is 8.24 right now. And to put that in context, the S&P 500 has a forward PE ratio of 21.7 right now. So in comparison to the market, Goldman Sachs is relatively cheap. Also, you're going to want to keep this number in mind because all future stocks, I'm going to be comparing the PE ratio against this so you can see how cheap or expensive it might be. Now, looking at the financial or the income statement, there's a few things I want to look at. The first one is the total revenue. This is one of the most important things to look at, and it's just the trend we're looking at. So are they making more money today, or were they more profitable and it kind of peaked a few years ago? And we can see with Goldman Sachs, they are making more and more revenue. If we come over to the balance sheet, the cash and equivalents is pretty healthy for Goldman Sachs. We can see that right now they have $191.2 billion of cash and equivalents on hand. So I definitely like that. And if we kind of go through this and look at some liabilities, one of the major ones is long-term debt. And we can see here that it's pretty flat, there's no major red flags, and their total cash on hand is almost enough to pay down their long-term debt, which is a very good sign. One of the last things I want to point out is that their net income is also looking very healthy, so it's quite exponential growth right now. If we come over to this independent ranking website, this is the first time I'm using this, by the way, so let me know your thoughts on it. I'll leave it linked down below. But this does a good job of showing the general sentiment in various ways. So of course they give you an overall rating, and this one is pretty good. It's at 8 out of 10. And then they kind of break it down over here. So the analyst rating, the consensus right now is a moderate buy. The blogger opinion is bullish. Hedge fund activity has decreased. Don't really care about hedge funds. The technicals, so this is like technical analysis, is positive. It has momentum right now. Fundamentals look good. And in this one I like. This is the news sentiment, so the kind of headlines with the company right now. In the last 7 days, it's been bullish. So I'm going to have to agree with this article. I think Goldman Sachs right now is a good pick. When looking at that PE ratio, it is well below that of the general market. The financials look good, and the independent rating company is also saying that this is a good buy right now. The next company they have here is General Motors, ticker GM. General Motors is a Michigan-based company that makes and sells cars. The company's shares have returned 119% to investors in the past year. In addition to vehicles, the company also sells financial services related to their purchase and maintenance. It is one of the largest and oldest automakers in the American market, selling cars, trucks, crossovers, and other related items. On June 8th, General Motors was named amongst the top auto picks of investment advisory Morgan Stanley on the back of the expected release of several electric vehicle cars in the coming months. Taking a look at the numbers now, the forward PE ratio is 9.46, once again, well below the general market. If we come over and look at the finances of this company, I gotta say it's not as rosy as Goldman Sachs. If we look at the total revenue, my favorite single measure to look at, we can see that it is slightly declining. Although if you look at these numbers and considering that this is an automaker, the numbers kind of tell a story because right now they are transitioning and embracing electric vehicles, and we all know that's going to be a huge market in the future. So what we could be seeing here is the decline of the internal combustion engine and the beginning of a pivot towards electric, and that might influence the revenues. But as of now, they haven't made that pivot yet, and we are seeing a decline in their internal combustion engine vehicle sales. On a positive note, when it comes to their cash and equivalents, right now they have $15.3 billion. And if we come down to their long-term debt, right now they have $16.1 billion in long-term debt. So that's not crazy. And their net income is kind of trending upwards, kind of sideways right now, but keep in mind this is an automaker and the whole field is being disrupted with EVs. So we're going to have to see how General Motors adapts to this. If we take a look at the rating agency, they are very bullish on GM. You can see they have the maximum score. The analyst rating right now is a strong buy. The blogger opinions is bullish. The news sentiment is bullish. The technicals are very positive, a lot of momentum, and hedge funds don't care about it. So by all measures, GM seems to be a pretty solid, undervalued blue chip company right now with a lot of potential upside if they get the EV transition right. Next up, we have BIDU. This might be something you're not familiar with, but it is a large growth company. So BIDU is a Chinese technology company founded in 2000, so it's not nearly as old as the other companies on this list. The stock has offered investors returns exceeding 61% over the course of the past 12 months. BIDU has interest in several internet-related businesses in China, including the search engine market, artificial intelligence, mobile ecosystems, self-driving cars, and others. The company is one of the most popular foreign equities on the US markets. So it is essentially the Chinese Google, like exactly a carbon copy of it. And the last piece of info here is that on April 29th, BIDU had announced that it would be launching a driverless robotaxi service called Apollo Go Robotaxi at a venue in China ahead of the Beijing Winter Olympics scheduled for 2022. So that's cool, kind of encroaching on Tesla territory, but also exactly what Google is doing. The forward PE ratio is 21.8, so it's right in line with the general market. It's not cheap, it's not expensive. And now if we look at the quality of this company to see if it justifies that valuation, we can see they do have solid revenue growth. It's not exponential, but they go from 15.4 billion to 16.4 billion in 1 year. That's pretty good. They have 6.3 billion in cash and equivalents on hand. Long-term investments are accelerating, which is good to see. And their long-term debt, it's pretty constant. I'm not seeing any major uptick in debt, which is good. And lastly, if we take a look at their net income, it's beginning to grow, with March of 2021 making 3.9 billion in net income. Taking a look at the rating, we can see that this one again has the maximum score, a 10 out of 10. The analyst consensus is a strong buy. Bloggers are very bullish. The news is bullish. Apparently, the 20 and 200-day moving averages are negative, but I don't really put that much weight on moving averages. And the momentum is pretty strong. So this is another very solid company, and if you're willing to invest in Chinese companies, the Chinese Google seems to be very high quality, and it might be a great stock choice right now. Next up is Citigroup, ticker symbol C. Citigroup is a New York-based investment banking company founded in 1812. The company's shares have returned 46% to investors in the past 12 months. It is one of the largest investment services in the world, with operations in Europe, Africa, Asia, and Latin America, in addition to North America. The company has a separate consumer banking unit to offer traditional banking services. On May 7th, a report in the Financial Times stated that Citigroup was planning to offer clients cryptocurrency services as interest in digital offerings was exploding across the world. The firm was considering trading, financing, and custody related to crypto, the report claimed. So I'm all about that. Whenever a traditional banking company gets into crypto, I think that's a solid move. We can see their forward PE ratio is 7.84, so it is relatively cheap when looking at the rest of the market. Their total revenues are flat and starting to decline, and I can see why they wanted to get into crypto, because Square, PayPal, and a lot of other companies have been seeing a lot more success and engagement when it comes to cryptocurrency. So if Citibank is successful in getting into crypto, it could be another really great revenue source for the company, but only time will tell how that will play out. When it comes to cash and equivalents, they have $282 billion of cash on hand. That's a modest amount of money. Their long-term debt is only $215 billion, so they're a pretty solid financial situation. And if we look at the cash flow and more specifically the net income, we can see that it's okay, but they definitely need a new revenue source, and hopefully crypto could be that for them. They're giving a rating of 7, which is on the high end of neutral. The consensus overall by analysts is still very strong. The sentiment is bullish, the news sentiment is kind of neutral, and I think this stems from the strong financial position they're currently in with their cash on hand versus their debt. But as mentioned, their revenue does need a boost. And if crypto is the answer to that, then this company could continue to do very well into the future. Now, lastly on the list, they have Berkshire Hathaway. So Berkshire Hathaway is a Nebraska-based holdings company founded in 1839. The stock has returned 58% to investors in the past year. The company is led by the legendary investor Warren Buffett and has taken stakes in several large corporations. It is one of the largest firms in the world in terms of market capitalization and one of the 2 non-tech stocks in the top 8 companies in the S&P 500 index. So this is the Warren Buffett company. That's kind of what this is. It's how Warren Buffett chooses to allocate his capital, and he is one of the, if not the most successful investors ever. He's legendary. So this is his company. He has a forward PE ratio of 24.26 on his company, so it's slightly above the general market. We can take a look at their finances. Gonna be honest, their revenues are kind of flat. Nothing alarming, but I would like to see more revenue. I like their cash and equivalents position. They have just under 50 billion right now. Something notable is that their long-term assets, namely net property, plant, and equipment, is increasing at a pretty steady tick, and that's all the acquisitions that they make. And then their long-term debt is pretty stable at around 100 billion. And right now their net income is around $42.5 billion. When looking at the rating, it's given a 5, which is a neutral. The consensus is a moderate buy. Blogger sentiment is bullish. News sentiment is also bullish. Momentum is pretty strong, but insider activity has been mostly on the sell side, and there's some other negative sentiment going on. But I mean, overall, this is a great holding company. It's ran by a legendary investor, and it has its hands in so many different fields that kind of like buying the general market. It's so well diversified, and it's just a staple in the economy, for being honest. So I like this company personally. And that's it. That is the top 5 undervalued blue chip stocks that hedge funds are piling into right now. I hope you guys enjoyed the video and got something out of it. If you did, leave a like, subscribe to the channel, and I will see you next time.